Welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, October 12th, 2022, and I'm pre-recording this Trading Places Live for Thursday, October 13th, 2022. Currently, futures up slightly. We've got the Dow futures up 51, S&P 500 futures up 7.25, NASDAQ futures up 15.25. Crude oil prices relatively flat, near $87 a barrel, and the 10-year Treasury yield currently at 3.92%. That's up 2 basis points. Keep in mind, we have a huge economic report out tomorrow morning, so you are getting this recording quite a bit early. So just keep that in mind. These futures could change significantly overnight. We have the September CPI out, or due out at 8:30 a.m. Eastern, and also initial jobless claims. So I'm sure what the market would love to see is a slowing of inflation. So look for that inflation number, the CPI, and also the core CPI to come in below expectations. And the initial jobless claims, I think it would be helpful if the market started to perceive that things were beginning to slow down, which would mean a higher than expected initial jobless claims number. We'll talk about both of those in just a minute, but I did want to let you know at least the futures are up in the evening. We'll see whether or not that holds overnight. So for today, we're going to go through the daily market recap, talking technically, relative strength, earnings spotlight, and then we'll wrap up the show with the 3 you must see. Before we get into any of that, just want to take everybody over to earningsbeats.com. If you scroll down, you'll see an area where you can subscribe to our free Earnings Beats Digest newsletter. This is a newsletter that I publish 3 times a week, Mondays, Wednesdays, and Fridays, always in the morning, and typically before the market opens. Try to get it out by about 8:30 a.m. Eastern, which is about an hour before the market opens. It's a very quick read, normally a couple of paragraphs and a chart. All it takes is a name, email address, hit that subscribe button, we'll get you set up. No credit card required, and you can unsubscribe at any time. Love to have you. So again, go over to earningsbeats.com, scroll down, and sign up for our 3 times a week free newsletter. All right, let's go ahead and jump into the action from Wednesday. So this is your daily market recap. I just wanted to go through and just look at some of the major indices here today. You can see the Dow Jones Industrial Average down 28 points, S&P 500 down 12, NASDAQ down 9. The small cap index, the S&P 600 small cap, down 7 points. Mid caps, the S&P 400 down 12 points. NASDAQ 100 down 5. So you can see it wasn't a big down day, but we did finish near the lows of the day across the board. And that was not a good look heading into a really big economic report tomorrow morning with that September CPI due out. Also, notice the VIX, relatively flat, sitting at about 33.5, but this is still an extremely elevated level. Anytime you get the volatility index up into the 30s, you've got to be at least aware that we could have some impulsive selling. And what I mean by impulsive selling is quick moves to the downside. Even though the VIX has been high and we've been breaking to all-time, or not all-time, but to 52-week lows, it's been kind of a crazy market, because normally when you get the VIX this high and you start breaking down the new lows, we tend to see the selling accelerate. We really haven't seen that much, which is really strange. I'm not quite sure what to make of that. Maybe we'll get a little bit more information when the CPI is released on on Thursday. All right. The other thing that I like to do, just to show you, when I go over here under the member tools, one of the things I look at first, as soon as the market opens, is a sector summary. I just like to get a general sense if the market gaps down or gaps higher. Just try to get a general sense of what's driving the market in terms of, is it a risk on kind of a day? Is it a risk off kind of a day? That type of thing. When I look at the action from Wednesday, you can see energy led, and then the 2 consumer stocks, or the 2 consumer sectors, staples and discretionary, both higher on the day. Now, this to me is a little odd when we consider that most everyone is worried about the economy, the fact that we're raising interest rates so fast and how that's likely to throw us into a recession if you don't believe we're already in one. But then that begs the question, why would consumer stocks be leading on a day like today when we're setting another new low on the S&P 500? It doesn't make a lot of sense. And that's been a theme really since back in May. We set the lows in May, and it seems like every time we've gone down since then, we've seen money rotate in a more aggressive fashion. And that normally would bode to me, or bode, I think it bodes well for the market anyway, that we probably would, expect that a bottom is going in. And that's what I've talked about. I talked about it back in June. We did bottom, go up 700 points. It was a great call back on June 17th. But here we are back down actually beneath where we were in June. So as solid as that call was, technically we have broken down below that bottom. So while it was a good bottom, it wasn't the bottom. And a lot of the indicators that I follow, a lot of the signals that I use look very similar now to what they looked like in June when I called a bottom. Sentiment's reset. We've got a lot of rotation into aggressive areas, even though the market keeps finding new lows. Those types of things suggest a bottom. So I'm not really, I don't want everyone to think I'm being stubborn. I'm not seeing any different signals. The signals are still the same to me. But again, we'll take a look at some of those signals in just a few minutes. Those were the only 3 sectors that were higher on the day. The other 8 sectors were lower. And if you look down to the bottom, look at what's leading to the downside. These are defensive groups. Utilities, 3.3%. Real estate, 1.3%. These were the only 2 groups to lose more than 1%. They're both defensive groups. So it's just not really lining up for what you would expect or what you would think that you would see in a market that is setting up to go further to the downside. And that's why I just don't think we're going to. But anyway, let's keep moving on. The 10-year Treasury yield, I just want to mention, in the morning, we will get the September CPI. That is expected to come in at with a rise of 0.2%. August rose 0.1%. So we are looking for a little bit of a pickup there. If we strip out food and energy, though, and just look at the September core CPI, that's expected to drop from the August level. August rose 0.6%. September, we're expecting to only rise by 0.4%. Initial jobless claims last week, 219,000. This week, we're looking for 225,000. And again, what I think the market wants to see is the market wants to see deterioration in economic conditions. That would include higher than expected initial jobless claims. So 225 is the estimate. Let's see in the morning how it comes out. But I think a number above 225 would be received more bullishly than a number below 225. We'll see. Now, as I look at the 10-year Treasury yield, this is the 10-year on a weekly basis. So this is on a daily basis. So if you look at the daily basis, if we break back out above 4%, we're going to see a negative divergence right here. I mean, this is exactly the way I would expect a rally or a trend to go. We move up, the daily PPO goes above the center line. When we top, the PPO is at a high. We pull back, we hit the 20-day, and then we rally. Now, as we've been rallying, notice the PPO is not turning back up. It's staying relatively flat. That tells me that we're running out of momentum. At least that's the signal I'm getting from the PPO, is that this upward momentum in the yield is beginning to slow. And if we look at a weekly chart, check out this negative divergence. So here on this high, you can see PPO going up. We pull back. We go back up to a new high, lower PPO, come back down right around the 20-week moving average. And now we put in this high, and look at this. We're still significantly below the last 2 highs on the PPO. So we've now got another high on the 10-year Treasury yield with another low on the weekly PPO. So we've got negative divergence on the weekly PPO on the 10-year Treasury yield. And then the daily, if we break out above 4%, we would be printing a negative divergence on the daily chart as well. So I'm just seeing signs of slowing momentum. And anytime the yield comes down, that generally results in the equity markets moving higher, especially the more aggressive NASDAQ. So that's kind of what I'm keeping an eye on. Now, we did appear to be reversing off of the high from 4% on the 10-year Treasury yield. And now this week, we've gone back up again. You can see we got to 3.98%. If we move up through 4%, we negate that reversing candle that we saw a couple of weeks ago. But if we don't take out 4%, and I think it's going to come down to the inflation report, the CPI in the morning. I mean, if that report is hot, I would certainly expect we're going to go through 4%. If it's about what's expected, my guess is maybe we're flat, maybe we pull back a little bit on the yield. But if we're weak on that inflation, in other words, if that's starting to show any signs of subsiding, I could see a big drop in the 10-year Treasury yield, and we could see futures soar. But that's a big if. I have no idea how this inflation report is going to come in. But hotter than expected probably would not be received well. All right, let's move on to talking technically. Wanted to go through first, show the S&P 500. So here was the lower low at the end of September, below that June low. We bounced, hit the 20-day moving average. This bounce, by the way, coincided with a very bearish sentiment reading in the form of the equity-only put-call ratio. The 5-day moving average got up to about 0.86. I'm not showing it here on this chart, but that, in my opinion, led to a short-term rally. And now here we are back down again at the low, actually closing just beneath that prior low. I think that was 35.85. Let me check. Yeah, 35.85. The Tuesday close was 35.88. And then on Wednesday, we fell back to 35.77, setting a new low on a closing basis. And the low intraday on Tuesday was 35.68. So we've now set new intraday lows, new closing lows. Strictly from a price standpoint on the S&P 500, this does not look good. Breaking to another low is not good. But, and this is a big but, let's take a look at the key sustainability ratios that I like to follow. The XLY versus the XLP. You can see, even though we have started rolling back over with this price action going down, we're still way above where we were back in May. I mean, we got down to 1.90 on that ratio. Now we're at 205. So yes, price is going down, but while it's going down, money's rotating into more aggressive discretionary stocks. Think back to the top. Yes, we were going higher, but money was rotating away from the more aggressive discretionary stocks. So that bearish rotation marked the top. Now we're getting bullish rotation, which I believe is going to mark a bottom. In addition to the XLY XLP, this was the QQQ SPY ratio. Now this is getting close to that May low, not quite down to it, but very close. But look at where price action has gone from 3,900 down below 3,600. That's a steep drop over the last 4 months, while these ratios are all moving higher. Look at the growth versus value. IWF versus IWD. This is the large cap. Again, yes, we're coming down off the August top, but we're still way above where we were in May. So price action keeps going down, but why is money rotating into aggressive areas? I'm just asking the question. It makes no sense. If you want to argue bearishly that the market's going lower, why would Wall Street firms be moving into more aggressive areas? It just doesn't make any sense. I think we're bottoming. I thought we had bottomed in June. So I'll take responsibility for that call. Even though we did have a really nice move off of that low. I mean, I called it right there on the bottom. We went up 700 points, but I did not think we were coming back down here. I certainly didn't think we were going to go back to new lows. Now, we're not a whole lot, not very far behind. If we were to take off from here, I would basically call this a double bottom, maybe a little bit of a head fake to the downside. But again, it's going to come down to that CPI report and how some of these economic reports come out, what the Fed says, those types of things. If inflation's hot in the morning, with the VIX up in the 30s, we could see a really big sell-off. It's very possible. I don't think it lasts, but that wouldn't stop it from happening. It could still be very painful on the way down. If the numbers come in a little bit better than expected, though, we could be putting in this double bottom, which is pretty close to the low we saw in June. We'll see. The NASDAQ 100, very similar looking chart, went down end of September, closed at a new low, bounced, hit the 20-day, and now back down again. One thing I will say is on this new low here, we've got a slightly higher PPO, positive divergence. If you look at that S&P 500, slightly lower price, higher PPO, positive divergence. Let's move on. Relative strength. Now, I think there are a few things to look at here with relative strength. First, before I get into the actual charts of the sectors versus the S&P, I think it's pretty clear when you just look at the S&P 500 where we're just down barely. If you pull up something like the semiconductors, I did this is a 10-year chart. And what I'm doing here, first of all, look at the PPO. This is a weekly chart, but the PPO has gone to a new low. While some areas of the market are showing positive divergences, slowing momentum to the downside, the semiconductors are not one of those groups. And what I did on this weekly chart, I believe that after the pandemic, we had a little bit too much of a move to the downside. I thought coming into this year, we had too much of a move to the upside. And now I think we're overshooting again to the downside. What I did with this channel is I grabbed some of the lows back in 2015, 2018, and then went right through the candles in March of 2020, because I think that was a little bit of an overshoot to the downside. And I just used that as the bottom trend line. I grabbed that line, drug it up here to this top, which coincided with these tops. And then as we came over here, you can see after the pandemic, how we kind of got out of our channel to the upside. I talked about that at the beginning of the year with the S&P 500, that we had gone through the channel to the upside. We just had gone too far. Semiconductors were one of the big reasons. Look at this move. From the March 2020 low on the semiconductors at 3,000, we went up to almost 10,000 less than 2 years later. This group needed to pull back. It's hard to justify the entire group gaining 3 times where it was in March of 2020 by the end of 2021. It just doesn't make any sense. I mean, my prior career, I was a public accountant. Was a CPA, was a partner in one of the largest firms in the Washington, D.C. area. I valued companies. I was on the audit side. I audited banks. But in no market environment should we see this kind of a markup. 3,000 to 10,000 in less than 2 years. I just think the group got ahead of itself. And so as the market rolled over, so too did the semiconductors. If you look at where they are now versus where they were 9 months, 10 months ago, then yes, it's very, very painful. But if you look at where they are now versus this channel, it's really just like, we're just going a little bit below the channel. I think we're probably overshooting a little bit to the downside. And I expect we're going to move back up into this channel. Is it going to be tomorrow? I don't know. Next week, week after, next month? I don't know. But I think we're overshooting to the downside. Software. I did, pretty much the same thing here, connecting the lows, dragging them up the highs. And once again, after the pandemic began, look at this move outside of the channel that we had been in basically throughout this secular bull market. So we overshot to the upside, and it looks to me now like we're overshooting to the downside. Unlike semiconductors, software, higher PPO with this lower move on the weekly price action. So we're starting to see a positive divergence. I think software is going to be a really good performer going forward, but it's a group that if the market is weak, even for another week or a month, software could get hit really hard to the downside. We could see another 20%, 15, 20%. I don't think it's going to happen. I'm just saying this is the type of group, very strong growers, that if inflation comes in higher than expected and the market starts anticipating higher interest rates, these are the kinds of stocks that get hit and that can get hit really hard. Internet stocks. Again, let's connect the lows coming across here. 10-year chart went a little bit below it here in March of 2020. Then I took those lines, connected the tops up here. And again, 2020 and especially 2021, we just simply broke out of the channel that we were in. If you connect all these lows, and maybe you want to connect the trend lines a little bit different, that's fine. Maybe you want to do these lows versus this low, in which case we probably have a little bit more room to get down the channel line. Channel lines, trend lines are very, very subjective. But I think this incorporates most of the trading of the internet stocks for the last 8 years. So I think that this is a pretty good range, and we're down at the bottom of it, even maybe slightly below. That leaves us a lot of upside potential if rates start to come back down. Just keep this in mind. Now, also relative strength. I mean, you can kind of look at those charts from a relative strength perspective, just because we've broken down to the downside out of the channels. They have not been good performers on a relative basis or on an absolute basis. And I do think that's going to change. But technology, a new relative low versus the S&P 500. I think that's important. It looks to me like we're going down to challenge the May 2021 low. Still got a little bit of room to go, but I'd watch that. It would be very, very bearish to lose that level. Discretionary stocks, huge move up for about 3 or 4 months on a relative basis, but we've pulled back. Can we get back through these moving averages? I don't know. Communication services, and this houses the internet stocks. I mean, this group for now a year, it has been straight down on a relative basis. Is it overdone? Possibly. I mean, you could have looked and thought it was overdone 10 months ago, and it just kept going and kept going. So I don't know where the bottom is. We do have a positive divergence on the relative PPO. Will that make a difference? I don't know. Industrials. Look at industrials breaking out to a 2022 high relative to the S&P 500. This group looks pretty good. Money rotating in. Financials, last 2 months or so, pretty strong. Money rotating in. Healthcare, all-time relative high, just set this week. Excellent action in the healthcare area. Staples, trying to break out to a multi-year high. Still hanging in there pretty good. Real estate falling apart. Higher interest rates can't be helping here. Utilities on fire throughout much of 2022. But since mid-September, really steep relative drop there. Energy continues to perform well on a relative basis. Almost looks like a little bit of a relative cup. Maybe a little handle going in here. Energy looks pretty good. Materials strengthening, but we took a big hit back in May and June. And so we've rallied a little bit off of that, but we still have a long way to go to get back to where we were back in May. Those are the sectors on a relative basis. So, I think industrials look good. Healthcare looks good. Staples look good. Discretionary did look better, and now it's kind of pulled back. Financials, I think, starting to look pretty good. They tend to do well in the fourth quarter. So I would watch industrials and financials. I think those are two areas that could have strong fourth quarters. All right, let's move on to earnings spotlight. Just wanted to go over a couple of charts here. First of all, Taiwan Semiconductor, they will be reporting tomorrow. I think the chart looks horrible. The group semiconductors is awful. But if you go down here and look at the TSM relative to semiconductor chart, we're much closer to the 52-week low than the 52-week high. That tells me Wall Street's not impressed with this company, and semiconductors already are horrible. We got the warning from AMD not too long ago, another warning in after hours from Applied Materials. Don't be surprised if we have a disappointing report, given the way this chart looks. BLK, they report tomorrow as well. This is BlackRock breaking to new 52-week lows. It's in the asset manager group. You can see over the last 2 months, relative strength's been dropping pretty rapidly. The group is dropping. I would not be expecting very good action here. How about PGR, Progressive? AD line looks good. Look at the price action moving higher. That's unusual. Look at the relative strength of Progressive versus its insurance peers. Going higher. And look at the group, the insurance group breaking out to new highs. This is what you want to see. Strong stock in a strong industry group. I would expect some pretty good things out of PGR. We'll see how these companies report tomorrow. All right, the three you must see. I'm going to start off with Uber. Now, Uber had a really rough day along with Lyft and DoorDash yesterday. You can see the big gap down. In the case of Uber, though, we held on to gap support and turned back around again. This is the level I want to hold. If we get much below 24.50, I'd be careful on Uber. Otherwise, I think it looks pretty good. Next up, Zebra. Just wanted to mention, I like that reversing candle off of the lower price action. Don't have the PPO up here, but I think I saw a positive divergence on Zebra. AD line, quite a bit off of that low that we saw back in June, even though price action's lower. I think that looks good. Not so bullish about the relative strength, though. This has been pretty weak stock. Maybe we get back up to the 20-day, but then I would expect it to pull back or roll back over and head lower. And then the last one I wanted to show you is Bed Bath & Beyond. Huge move. Probably a lot of this is short covering. Since then, though, all the way back down, getting close to the double bottom that we saw in July. Not looking very good here for Bed Bath & Beyond. All right, that's it for me. I appreciate everybody tuning in. I'll be back next week for your next Trading Places Live. Have a great rest of your week. Everyone, enjoy your weekend, and let's see what happens with the inflation report. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.